English for later. Hello, I'm Maureen, and I'm talking to you from New Mexico in the name of the U.S. Federation of Worker Cooperatives to our co-op clinic. And today's workshop, as we already mentioned, has to do with taxes. I'll try to talk more slowly. We're going to be specifically focusing on co-ops that are structured as LLCs. And we are very happy to introduce you to one of our team members. We are a nationwide grassroots organization. We have members in all states, and we provide technical assistance, training to co-ops, and we have a co-op clinic. And a member of our co-op clinic is here today to present the information. And so we want to thank those of you who are here, who are already U.S. Federation members. We'd like to thank you. And if you are not a member, we do want to remind you that if you become a member, you will have available our technical assistance and our assistants, such as Daniella, who will be presenting today's session. Daniella, who's originally from Chile, is a cooperative development consultant since 2017, and she's a certified coach and trainer on these topics. She's part of a cooperative, and she's provided technical assistance to small co-ops and democratic work places. She's also a peer advisor at the Co-op Clinic program, and she's the co-chair of the Federation's International Committee. She's the vice president of CICOPA America's board and president of CICOPA North America. We are so happy to have Daniella here again to present this information. And with that, welcome, Danny. Go ahead. Thank you all. I'm also very excited to be here where we can share our experiences and learn from each other as colleagues along our way as cooperatives. I also want to thank the entire support team and to all the participants who are here. And I will answer as many of your questions as I can, depending on what I know. Let's go over the agenda. We're going to do a short poll, and we'll put the link in the chat just to see where all of you are right now. Then we'll talk a little bit about business documents for LLCs and what your responsibilities are. We'll talk about business tax returns, how to prepare them, and also the process of individual tax returns, how to do them, what documents you need, some tips. What's tips in Spanish? Some good practices that we have come up with, and then we'll have time for questions and answers. So please note down your questions, and we would be happy to provide you that support. Next, please. So the poll, if you could answer the following questions in the chat. Have you ever filed as self-employed, and put yes or no in the chat? And I'll give you a minute to answer that. I need to go deal with my cat who's at the door, and I'll be right back. I don't know if you could hear her meowing out there. So yes, no, great. So we're seeing some of the answers come in the chat. Have you ever filed your tax returns as self-employed? So we're kind of getting a feel for how much knowledge there is out there. I didn't realize that everyone knew so much. So who here are members of a co-op that is an LLC? So who is not a member of an LLC co-op? Because I assume that most of you probably are. I don't see anything yet. I see a yes. I think we're all in the right place. And also, if you could put true or false to the following. Are you a person in charge of your cooperative's finances? If you could answer that, you can put a T or an F for true or false if you are in charge of finances in your co-op. But write true or false because it's hard to get the letters between the English and the Spanish. Great. So there are people here who will need information, and there are others who already have information about their co-op's finances. I'll try to cover as much as I can. So that it'll be for both groups, for those who are in charge of bookkeeping and for those who are not as aware. First, I would like to give the disclaimer. I'm not an accountant or an attorney, and what I'm offering here is things I've learned from my own experience in my roles in my own co-op and 7 years that I spent working on admin and finances as my co-op's bookkeeper. So I hope that this helps you a lot. So there will be questions. I will not be able to answer, but I will note them down and I will talk to my accountant friends about them so that I can get back to you. So let's get into it. And thank you so much for participating in the chat. That helps me a lot. It gives me an idea of who's here and how to help you all. So tax returns for cooperative businesses who are LLCs. So these are the business returns. We'll talk about the documents, the structure, the process, important dates. Because if you make mistakes when you're dealing with the IRS, it can cost you a lot. And we'll also talk about steps, decisions, and good practices that can also aid. So first, this includes LLC businesses, which is known as a Sociedad de Responsabilidad Limitada in Spanish, a business with limited responsibility. And so in the beginning, when you signed up, an LLC is when everybody is responsible for the co-op. And there's other kinds of co-ops that are mixed. And some of them have immigration documentation and others don't. And the important documents that are related to this, and to also talk about the benefits of doing business with this structure. And we also want to mention that the documents I'm going to mention are ones that you should have up to date and keep them on hand. They need to be accessible to all members. The first is the Articles of Organization. And this is how the business needs to be registered. This is necessary for registering the business before the Secretary of State, and the details are different in the different states, so I'm not going to go into details. But this document has basic information about the business, and more than anything, it talks about what you are, what you call yourselves, what your business is, who you are. So the articles of organization is based on the LLC law, which are limited liability companies, which is above the articles of organization. And then below the articles of organization comes the operations agreement. And in California, the operations agreement does not have to be registered with the Secretary of State. This is the document that represents the contract among the members, the partners. And these sets out the responsibility we have as owners. And this is particularly important at the end of the year when we have to divide up the earnings and the reserve fund, if you've decided to have one. Guaranteed payments. So all of these agreements among the partners are in this document. Usually it is not filed with the Secretary of State. And also, if you want to open a bank account, or if you end up in court because you've been sued, you're going to need this document because it explains how you govern yourself. Then the policies document. Could you talk a little bit more slowly? I just want to mention another disclaimer. I'm a Chilean and I speak quickly. So the policies manual is the document where we put down the agreements that are in the form of policies to be able to put into practice the agreements. So we have guaranteed payments, for example. How are we going to do that? That'll be in the policies. It doesn't cost money to change it. But you may need a lawyer to help you with it if you do change it. And then what the next one, let's see. And another thing that we need to know about our structure is our finances. And ideally, you will have an established system so that the person who's in charge of finances issues periodic reports, either monthly, quarterly, both. In our co-op, we have monthly and quarterly reports. And the quarterly report looks at budget versus actual. And then for taxes, we're going to need the profit and loss statement and the balance sheet. These are two documents at the close of the fiscal year that need to be ready with all the information in it. They need to be reconciled, and you need to have the accounts. And this needs to be turned over to your accountant to do whatever tax things need to be done. And then another important thing that we need to know about are our internal capital accounts. Sometimes we have a bank account in the name of the co-op, but the internal capital accounts is a way of organizing the internal accounts of the co-op. Everything will be in one bank account, but the accounting system that you'll use some kind of software for that, probably, or you should. Or you might have Excel sheets, which is not recommended because there's a lot of things that are coming in and have to be added and subtracted and multiplied and divided, and it's better to use software for it.
And where we can find a bookkeeper who can keep our books. So the capital contributions are assigned internally. And so that's where we're going to be able to see every year how they're being, these capital contributions are being assigned. So we're going to see, and you know what I'm thinking about, Maureen? Sorry, you did a copy of the one I sent because I sent the one that was actually updated. If you can uh, take the one that the newer one, because this might be an older one, if you can use the original one that I sent, because there are a few changes there. Yeah, I'm gonna share the screen for the. In the meantime, if there are any questions, you can place them. How are we doing up to now? You can speak with your microphone. You can write in the chat. Thank you. This is great information that you're sharing with us. I don't turn my camera on because I'm driving right now, but I am hearing everybody. It's great that you're able to listen to. I have a question. Thank you for your time. Some applications to be able to carry out the bookkeeping. We don't always have access to QuickBooks or those kind of platforms. Maybe you can share some suggestions of what could be more accessible. Yeah, I can share tax-wise that in my understanding, remember, and the experience of other people is very good. But if they're in a kind of a relatively smaller organization, once you're more advanced, a bigger organization, maybe you can start using QuickBooks. There's some things that Wise doesn't have, that there are reports that doesn't have it. But for the beginning, Wise works to be able to count for income and expenses, and I'm gonna share it in the chat. So that's a way it's called, Wise. And so for people who use it, they say it's pretty good. And so the first stages of the organization, it's been a good tool for that. Thank you. You're welcome. Can I confirm that the one I'm sharing to you by chat is the one you want me to share? Yes, sorry that I didn't document that. Yes, that's the one. Thank you. Perfect. Thank you. And I'm sorry. Perfect. Thank you. Perfect. So capital contributions is where we were. So the capital contributions that we made at the beginning of the business, and we're also gonna have the uh, distribution or the equity, how much we're assigning to each person. And so we're gonna have these internal capital accounts and how much we're distributing to or assigning to each person from the profits. So what's the tax structure of our LLC? By default, if we don't change this, generally is taxed as a partnership and uses the pass-through format of the profits or losses to its members and partners, who are the ones who pay the respective taxes, their income taxes. And this is done through a Form K1 or Schedule K1. And so this is the document that the business has to give to each one of its members. And that's where we're going to see how much that person earned and how much was distributed or assigned to each person. The cooperative can pay annual fees. For example, here in California, $800 for the first $250,000 of income, and then it keep going up according to how much of an income the co-op has. So this is a fee for being an LLC, and so it's paid one time a year, unless you want to pay an estimate before the next year. So next one, sorry. Thank you. So this declaration or information return, the business doesn't pay taxes for profit or loss. So for these incomes, it's going to be the members who pay that. So this is called an information return, what the LLC reports, and this is where you report income, gains, losses. So to the IRS, we're reporting this, I'm an LLC business, and this is what happened. The deductions, credits, etc. If we're making deductions, if we're reimbursing expenses of our members, these are deductions of our business as well. And the expenses are also part of this. And this is done through the Form 1065. So this can have a different name according to the state, how they identify it. And so the deadline for this is March 15th of each year, and you can request an extension of 6 months. In case you needed an extension, you would be able to do that. So this is declared on March 15th, and you can pay it until April 15th. And the allocation of profits or losses in the capital accounts of each member. So we can say that this is our reserve fund if we decide to not distribute them. So when we retain earnings in our business, this is going to be our emergency fund. And it's strongly suggested that you have this to have this kind of reserve, because where we live, many cooperatives follow uh, this idea, and that they understood that this was important. Sometimes they weren't able to do it, and they were able to face COVID in a different way. So this reserve fund is ideally 6 months of the business. So we want to arrive to that. And then you can have this reserve fund every year. You can build up on it. Thank you. So a little bit about talking about the flow of the revenue from clients to members. So this income that we're going to be paying taxes. So how does it go from the clients to the members? So the clients pay for a service. This goes to the operating account, the general account that the co-op has. And there's a percentage that the co-op retains to cover its expenses. And the rest of it, with these expenses, you have guaranteed payments. So that also, it's the first income that goes to the workers, which is then in the frequency that you've all decided, maybe monthly, might be semi-monthly, and might be quarterly, however you determine it. The more stable or the most frequent, it gives more stability to the work that we're doing. And then we have the end of year profit allocation, because once we've paid all the expenses, all the guaranteed payments, we have the end of year profit allocation. And so this goes to the member capital accounts. What am I going to pay? I'm going to pay the income tax So both the guaranteed payments and the earnings are part of that number for which I'm going to pay income taxes. Okay, next one. To give an example, like an exercise, how are these, how is this income going to be reflected on the K1? So this is an example of an income declaration. So we might say that the gross income was 125,000. The expenses, 100,000 of those were guaranteed payments, and office expenses were 10,000. So if we subtract the 100 and 10,000 of expenses, we're going to have a net profit of 15,000. And let's say there's 10 members, so we can make an easy division here and we don't have to worry about decimals. So let's see how that's going to be reflected in the K1 of each person. So this is an example of a K1 that we did it for this purpose. And you can see the line 1 of schedule K1. You're going to see that we divided this by 10. Maybe we decided to divide it all by 10, or maybe I received 10%. I'm going to receive the 10% of the profit. And so I would have received 10,000 of the 100,000 that we all paid ourselves in guaranteed payments. So what I have to pay in income taxes is on the 11,500. So 14C, this is done by the accountant. This is done by an accountant. So when you see this number, why is this a higher number? The IRS wants to know how much you would have earned if there hadn't been expenses. So at the left side of this sheet, you're going to see a small statement where you're able to review how much you received, how much was allocated, and what your balance of your equity account is. We always recommend that the cooperative, through the accountant, does this process of delivering every year like a promissory note where it states how much was allocated this year, how much was from the previous year that we kept for a reserve fund, how much should we distribute this year, and to have the balance. It's a good practice. So next slide, please. So what's the process like? We close the books on December 31st at the end of the fiscal year. And what we want to do is that we want to deliver these accounting books to the bookkeeper or accountant. And to be able to do that, we have to review our accounting. So we have to make sure that the record and categories are done well. And this is usually the person who's in charge of doing the finances of the business. And oftentimes helping ourselves with this bookkeeper, if they inputted everything correctly in the program, whether it's Wise or QuickBooks or anything else, and make sure that you review it and the monthly review of the balance with the bank, and that if the bank statements are in accordance with what we have internally, the records of guaranteed payments and early distributions, and we might have an emergency fund. So sometimes we can take out some earnings in advance, and those are agreements that you have to make in a group. And then you have the records of capital contribution credits and business loans, and then we close our books and we pass it to the accountant.
And then we make sure our accounting is up to date and generate the necessary financial reports, the P&L or profit and loss, and find out how much we earned or how much we lost. So then you're ready. And then we turn it over to the person in charge of the taxes. And then this person bases what they do on our operating agreement about how we're going to distribute the earnings or losses. What's important here, or a good practice, is to save your receipts. You can do that electronically. The IRS permits this, especially if there any expense is over $75, you have to have some kind of a receipt or an email or something to justify the expense. So save your receipts in a file on the if it's an expense over $75, and this can be done electronically. And then this is also important to keep for at least 5 years. And after that, according to the IRS, there's certain information that you can get rid of. But you need to kind of figure out how many years you need to keep each kind of information. And then this should be handed over to your tax preparer in the first weeks of January. And these professional services that we receive from another LLC, and they'll send us a W-9. And for example, if we hired a graphic designer to do a flyer, we'd pay that person, and that person sent us a W-9 because we paid them over $600. If it's under $600, they do not have to generate a W-9. Why? Because the accountant has until January 31st to issue W-9s to taxpayers. And these are the forms that, or a 1099 for people who are independent contractors, and they have to be issued before or by January 31st. So we have identified that person. The accountant has everything they need. The next step is the allocation of profits and losses. We close the books. The tax preparer looks at them, they revise them, they adjust them, and they tell us what the net income, profit or loss is. And then we have to allocate this, and it's the tax preparer that assigns to the capital accounts according to how we have decided that this allocation will take place. It can be based on hours worked, or it can be done equally among everybody, but the allocation needs to be made. And then based on that, is the next step. And all of this is established in the operating agreement. And this money gets allocated to our internal capital accounts. That's the first part. Next. So the money's allocated, and we know how much it is per person. And here there's a second decision that needs to be made at this time. Are we going to distribute some of this? If we follow the same example, we have 15,000. Here we decided to distribute it, or to not distribute it, and we decided to keep it all for 2 years. We are not going to make any distributions. Or rather, we could decide to retain a percentage. and we only distribute 5,000. And so we're holding on to more than we're distributing. So when we make these decisions, the financial health of the business and its members should be the priority. We have to maintain our stability for our work, and we want to make sure that our business is healthy and that it's working for everybody. Am I talking too fast?
Sí, un poquito. Sí, pues, gracias.
So, financial health is a priority and our personal financial health is important, and they're very related because we can have decent work and we have to decide what benefits we're going to provide. And as we grow, we can improve these things. It is very important for the business to be stable and to have a reserve in case of an emergency. And it's also important to point out that this year we have distributed or retained a certain amount. Is that we pay this on for the year that the amount was generated. And you are going to pay taxes on it. And then once it's in the capital account, you won't have to pay taxes on it again. Now, we go to tax preparation for the LLC's members. We'll talk about the process, documentation, and important dates and steps and decisions. What's important is that you will have this presentation available to you because it's being recorded, and so you can review this later. So the tax structure for ourselves, the LLC's members, we are going to file federal tax returns, and we have to pay our federal taxes and our state taxes. Every state has its own way of calculating state taxes. So the 1040 form is a federal tax form. And we are, as members, responsible for paying taxes quarterly. We have to pay estimated tax, pay quarterly estimated taxes. So from January to March, and then I have to pay the percentage that corresponds to how much I've made, and I have to send this to the IRS, and this happens 4 times a year. January 15th, then April 15th, June 15th, September 15th. And the date changes a little bit. It might be the 16th or the 17th. So if the 15th is on a weekend, it might be the 16th or the 17th. So the amount that you want to send as your quarterly estimated taxes is a percentage of your guaranteed payments for the prior 3 months. And you do that 4 times a year. Could you please speak more slowly? And this happens 4 times a year. Guaranteed payments, what I received in the prior 3 months. And then around the 15th of the following month, I do have to send my estimated taxes to the IRS on Form 1040 ES. And it's important to understand that I'm not going to pay taxes 4 times. What I'm doing is paying my taxes ahead of time. And this is my responsibility as a worker owner of a co-op. And the business can support me Every time you get a guaranteed payment, we can create a savings account for the taxes of each partner in the accounting system to hold on to that money so that when the estimated tax deadline comes up, which is paying your taxes ahead of time, you will have that money saved rather than saying, oh, I didn't put anything aside and I forgot that I had to pay. The other thing you can do is to be organized. Every time you get a guaranteed payment, you put aside a percentage of it in your own account. And this helps us so that when April 15th comes up, we have sent in a percentage of our income 4 times. So at the end, we either have to pay the IRS very little, or we may have paid too much. We may have another job that brings in other income. And that's, if we pay too much, we will get a refund. If we pay too little, we'll have to pay a little bit more when we do the tax return. And there's all the deductions you get when you do your own tax return. And this all might lead to a refund. Next one, please. I already said this. Okay, here it is. The 1040 ES. This is the form you're going to fill out quarterly. The important thing is to review the information. And the regular 1040 tax return has the same information at the top of it that is on the estimated tax form. And so when we do the estimated payments the first time, we have to make sure that we put our names down exactly how they go on our tax returns. And then your address. And if you file jointly with your spouse, you have to put your spouse's information also. But the first name that appears there would be the person who's actually sending in the money. So if my spouse is the one sending in the money, I would be on the second line. Then I'm going to go back a little bit to this one. As I was saying, my income, it will include my guaranteed payments. If we were given any kind of benefit or a bonus, that's also got to be included in our income for the purpose of estimated payments and will be part of our income. And I need to pay taxes on all of it. Profits include the portion distributed plus retained in your capital account. So all of it, if all of it ends up in the bank account and none of it's distributed, you still pay taxes on it as part of your income. But when it's eventually distributed, you won't pay more taxes on it. The taxes are paid for the year that it was generated.
So what are the steps that you need to do for preparing your taxes? So you can be using Wise, or there might be other programs that you can use that are free. I have a preference for this one. Oh, it's called Wave, not Wise. Sorry for that mistake. I'm gonna put it down well here. So it's Wave. Sorry about that. So that's the one you can use. If not, we can use it in an Excel spreadsheet. So the person who does our income taxes is going to need to understand what are these expenses that we incurred in, what are those expenses that we can deduct, what are the forms that you receive. So first of all, you have to categorize all transactions. and put down what are the transactions that we're carrying out, what are the expenses that we had that are not personal expenses. So it's very important to separate the business expenses with what has to do with just my personal stuff. So also keep those receipts, anything above $75, you can keep them electronically or in paper. And then you have to reconcile the information with the bank. And ideally, you're reconciling what is stated. If we're using Wave or QuickBooks, that if we did it by hand, that number reflects what stated in the bank. If I'm saying this is the amount of expenses, they also have to show up in the bank statements. So next one. As I was saying, collecting and saving all receipts, and also if we have personal accounts, also save those statements to be able to identify what are those expenses. So ideally, if I'm an independent contractor and I'm generating income through 1099s, I want to understand what are the expenses that I have to provide those services. So ideally, create a separate account from your personal account so that they're not mixed up. And if not, then you have to kind of figure out those expenses later, and it's going to take some time. So it's important as well to the reimbursements you receive them from the co-op. You can't put them as deductible expenses on your individual returns. If you're putting them in the business side, you can't also count them on the individual returns. So you have to be clear on that because that's where you can have problems. And so also now let's look at what these forms are. So let's identify which are these expenses, put them down in writing. So do this review and separate what's personal and what's business. Maybe I have another consulting and consultant business. So just make sure you have it all separated. And we're doing these expenses with the form K1. And I have to look for the expenses that I did. And I can do it with that form, or I can send a check to the IRS, or I can do it online with the IRS website, and I can make that payment online. Yeah, online payment. So what am I gonna need to be able to pass on to the person who's doing my taxes? So I'm gonna need to, sorry, close the door, please. I'm gonna need that the accountant knows how much I sent in each one of those payments and the dates of those payments. If I sent the form, if I sent that payment, what month did I send it? And if I sent it, if I did it online, you can generate a receipt. You can print it out or make a note of when I did that transaction. So that's important to communicate to the account, because if we want to get money back, if we paid more, or to be able to understand how much we didn't pay, and then there was a difference of how much we owe. And so we're gonna need to look at all the forms. So you're gonna see that there's already 1099s arriving, and those are the first ones because the accountant or bookkeeper has until the 31st of January to be able to send those out. And you're gonna see that those are arriving to your homes, the 1099s that are related to your work as a contract, as an independent contractor. So if I'm also an employee at a place, I'm gonna receive a W-2, and these are gonna be arriving in this time also in February. Depends on how fast each company does that work. And also as a worker owner in an LLC, I'm gonna receive my K1. I may receive others as well. So I might receive a 1099 INT, which is interest rates. So these are the bank is gonna send me if I earned any interest in my bank accounts. And there are other forms that I might receive. So if I have a 401k, other places where I might have had expenses or income. Next one. So another important thing here is we identify which are the expenses. We separated everything. We identified the forms that we're receiving. And here's something that has been happening a lot after the pandemic, that some people have been doing their work from their home. And so there are things that we need to keep into account. So there are two basic requirements for your home to qualify as a deduction. And so that's important to be able to know that. So that space is regular and exclusive for work. So it can't be your dining room or the table in the kitchen. Unfortunately, that's how the IRS uh, wants to account for it. So if that space is used for other things, uh, if it's not exclusively used for work, you can't deduct that. And also, next slide, please. So, and then this is also, how am I going to calculate this deduction? So there's two ways. If I'm working for a company as an employee, the company is the one should reimburse these expenses. But those of us who are worker owners and are not employees, we're gonna want to put this deduction in our taxes. How can we calculate it? So there's two different ways. So the first one is to divide the cost of running the house. And so that includes water, electricity, gas, etc. So we're gonna divide that based on the percentage. We measure the space. And so having the total measurement of the house or of the department, I'm gonna get a percentage of that. How much of a space is it? A third, a quarter, a fifth part of the house? We're gonna measure that. And so that percentage that we receive, that the space that I use for this in relation to the total space of where I live. So I'm gonna use that percentage and use that percentage of each expense. And so that's where we make this calculation. This is not something we're gonna do, but the person who's in charge of my taxes, they're gonna add that up and they're gonna put that in the C annex. And that's where they're gonna be able to calculate the deduction or the Schedule C, sorry. And so this is a more complicated one, but this is the one where if it's a large space in relation to the space where I live, if it's a large space where I've been using in the office, then you're going to want to do that. But there's a simplified way, which is if it's a smaller space, if I have just for this, and you're going to measure the space, and that space, you're going to add $5 for a square foot for the commercial use of the home. And so that's going to be the deduction. If the space was very large, this is not going to be useful because the most you can deduct with the simplified process is 1500. So if the space is very large, we're going to take the percentage of each one of the accounts that are associated to the work from home. And so here there's a question that's important to know. So how much tax will I owe at the end of all this? So this is where we have the anxiety. How am I going to pay in taxes? And so this is a difficult question. I'm not an accountant, first of all, and each case is going to be different. So here is a general guidelines to be able to have an idea is to be able to add everything that I received as income, deduct all the expenses that I have, And I'm gonna send something along with this. There's a table, there's a list of by different categories and the different conditions. If you're gonna do taxes, filing jointly, or if you have dependents, there are stipulated amounts. But as a general guideline, is that if you are single filing by yourself and you don't have dependents, you have to claim at least 25%. So between 25% to 33%. And then you have to see the expenses. With the expenses, how I'm reducing this payment of taxes with deductions. And then also for members with dependents, a worker who has a child and they're claiming them in their taxes, maybe they're doing taxes not filing jointly with their spouse. So this is put it can must be in our taxes, and so then I should plan for about 20% in taxes. If they have two children, then it would be more 18%, might be a good number to ensure that we're not going to have to pay taxes at the end of the year. Or if we didn't do, is that in April we need to have that money. And if not, you can do payment plans. The IRS wants you to pay, and then so they have ways of, figuring that out. And then there's 15% if you have three or more dependent children. So that's about the minimum you can pay in taxes. So, and if I'm single, I have no dependents, I have to think about at least 25% and making these payments and estimated payments of everything that I've received in the 3 months before. If I have dependents, to begin to see the other percentages. And if I'm gonna be declaring my taxes with my spouse, it's important that everything that the other person puts in is also gonna affect me. If it's a part of a total. And always ask, is it better to file jointly or is it better to file just by myself? And I'm not an accountant, but our accountant is that it's the same. The IRS knows where you are, so I'm not gonna be able to advise on this, but that's a response of our accountant. The IRS knows who's married with who. So if the person is employed, if my spouse is employed in a business and is retaining only 15% of the minimum, but we don't have any dependents, if they did not retain sufficient income for the status that we have of being filing together without dependent, that's going to be reflected here, and we'll also have to pay that. So we're going to have to pay whatever we didn't retain. So, and then as a general rule, to be able to tell you that the most important thing is that the more detailed information that we provide to our tax preparer, our accountant, the a greater probability that it will be submitted without any mistakes and we don't have any expenses with the IRS, which doesn't forgive anything. And so another piece of information that's important is that it's our responsibility of the members, partners to keep the cooperative updated with their personal information, our address where we live, our ITIN or our social security number. If it changed for any reason, it's important that we inform the business because the K1s are going to be generated with the information they have. Normally, the person who is doing this is going to be asking, is anybody changing their personal information? Because once they've generated, in my personal experience, when we lost the with the IRS, it's harder to recover it. So we don't want to be in that position with the IRS.
So we need to keep our information up to date. So I would like to open up the floor now for questions. I see that there's been a lot of going on in the chat, but I haven't had a chance to review the chat. I could read it for you. Thank you for this presentation. And thank you all for being brave and staying here till the end. So Jenny's asking, what happens if you don't distribute all earnings to the capital accounts? Because some earnings were retained related with the work of non-members. Jenny, I'd like to understand what you mean by non-members. I want to understand a little better what you mean by that.
I can.
Could you come on mute?
Yeah. We have employees at our worker co-op. And so when we do patronage, the percent of hours that they work is just kept in, is retained, but not, in capital accounts. I guess it's in like a company wide account, like reserves. But I think my question came up earlier on because the way you were describing some of the processes, it was as if all of the profits were going to be distributed into capital accounts. But I mean, maybe this would also just be a capital account that is for the company, but it's not distributed to worker owners. Oh, you know what? We are filed under subchapter T. I'm not sure how that plays into this. Okay. Okay.
When their decision is made by the business.
Great. That clarifies the difference for
Yes.
us compared to what you're talking about. Thank you.
Yeah, that's not the case for the partnerships. Thank you. ¿Hay otra pregunta?
La siguiente pregunta también voy a mandar a través del chat.
The next question from the chat says, if the co-op members make up the labor force of the business, how do you account for the expense of labor as a business, since payouts are viewed as profits? And that's from the chat. The payments. So the labor costs of the business are going to reduce the profits. And those will be the deductions and expenses that the business will have. So what we'll get at the end in earnings or profits will be after deducting all of that. So that all goes on the K1. All the expenses that are paid and how much is left over, or how much would have been left over if there hadn't been any expenses. I'm not sure if I understand the question exactly, but there are labor costs or labor expenses for example, reimbursements, business expenses. Let me think. Labor, also food, meals. So all of this will end up being subtracted from any profit. And this is independent from our guaranteed payments. This is a separate from that. Amalia has a made the question. Amalia, do you still have doubts about this now that you've heard the answer? And if not, let's go on to the next one. There's another question from Jenny that's in the chat that says, let me see, hold on a sec. We have our worker owners on our payroll. And then they will distribute patronage after the end of the year, which they would need to pay taxes on. Would they need to pay quarterly estimated taxes on a projected patronage payment? All distributions that you make during the year as an LLC, the fiscal year ends on December 31st. As I was saying, distributing profits, they can also be distributed ahead of time, early. And they can either be put into a savings account or given to you in a check. But yes, you have to pay taxes on all of this, anything that's a guaranteed payment. I don't know if I understood, I don't know if the person who asked, Jenny also asked that. So Jenny, if there's a distribution during the year from that same year, and you're going to pay taxes if they are part of your, and you need to take them into account in your estimated tax payments. The next one is question, are member partners required to pay estimated taxes quarterly, or is paying on an annual basis an option as well? That's also in the chat. Yes, because the IRS says you might be fined if you do not pay quarterly. It doesn't say there will be a fine. It says you might be fined. My experience is that I've had colleagues in the co-op because they did not pay their estimated taxes. I don't know what the IRS uses as the basis for fining people, but it is each person's responsibility to send quarterly estimated payments. But what I have been able to figure out that is that what the IRS wants is to receive ahead of time something similar or close to the final amount of what you would have had to pay in April. So if in April my tax return says that I owe so much, then I need to have been paying this amount quarterly. And I've never had a fine, even though the amount hasn't been the right exact amount. So what the IRS wants, if you couldn't send it in your first payment, you can send it in the second payment for both of the periods. But they want to make sure that you're sending more or less enough to cover the final amount that it will say you owe in April. And that's your responsibility as a worker owner of an LLC. And the IRS could fine you. They don't specify clearly how they make that decision, but that's been my experience. And thank you. The last question that was in the chat is, and I don't have all the vocab for this. I'll send it to you in English and hopefully you'll understand the question. And if someone could translate it into Spanish, that would help. Which one is it? The very last one?
Es la siguiente, perdón, es lo que se trata de K1.
It's the one about the K1. Oh, is the K1 a way, the way to report a quote unquote draw? Is a draw a withdrawal? Withdrawing? So the draw or withdrawal, so when we make withdrawals, first of all, there has to be a policy. If you're a co-op, you need to have a policy about worker owners making withdrawals. Maybe it's a benefit that you have a right to, or maybe you're asking for a loan, but you have to define where that money is coming from. But if it's coming out of your year-end earnings and you want to take an early allocation, you're still going to have to pay taxes on it, and it's going to be on your K1. And it's going to be an early profit distribution. That's how I understand it, but I'm not 100% sure. I'll write it down as an owner's draw. But what I understand is, how am I enabling worker owners to withdraw money? Usually this is through policies, a bonus, a benefit. It's not like a partnership of an LLC with partners who can take out money when they want. There needs to be a policy that backs up this kind of withdrawal. And so depending on the policy, it will specify where the money would come from. So it would come out of, but if it's money that is from this year, you're going to have to pay taxes on it if you take it. So if it's retained earnings, but however, if you're taking the money out of your retained earnings from previous years, you've already paid taxes on the money. So the policy about where the money comes from is important. But all the money is recorded on the K1. I think that was the last question in the chat. Does anyone else have a question? Please unmute if you'd like to ask a question. I have a question. You mentioned that you have to keep receipts for expenses over $75. What about if they're less than $75? If you have tax deductions from your taxes, whatever kind of deduction, for cleaning services, parking, your deductions. For parking, if the expense is over $75, you have to keep a copy of the receipt. And you have to write it down in your books. And if you paid in cash, and it's less than $75, don't worry about it. You're not going to get audited for the $5 you paid for parking in the parking deck or parking lot. But if it's over $75, yes, you need to keep a receipt. So these are expenses over $75. You must keep the receipt in case there is an audit. Now I understand. And one last question.
So the last every month you have to pay like $5 and the maximum was 1,500, or is this a monthly thing or an annual? No, it can be a little bit confusing. So if we're working from home and we want to deduct those home expenses of using your home for work, so there's different ways to do it. There's a simplified way, is that I take the measurement of my space and I take the square foot of that space that I'm using. And for each one of those square feet, the IRS says you had $5 for each one, and whatever you get is what I'm gonna pay for the use or reimburse or deducting for the use of your home for as a workplace. If not, and so that has a maximum of 1,500. That's what the IRS says. If the space is very large, then it doesn't make sense for you to use that simplified way, and it would be better to do a percentage of the space. And so I have my home, the percentage of that space I'm using. So what percentage of the electricity I'm gonna deduct from that? How much of the water is gonna be paid by work? And so you're gonna be deducting that way. And so adding all that is gonna be a deduction for the use of home for your work. Is that understood better? Yes, thank you. So nothing monthly, so that's just at the end of the year. So we're almost at the end. We wanted to share, Daniela, to talk a little bit about Colmenar. Thank you. I'm gonna share the presentation, some guidelines to be able to look at the dates for the estimated payments so that you have them for 2023, what's the form, and to tell you, I'm co-founder and worker owner of Colmenar Cooperative Consulting. So there are 3 worker owners and we work at the national level. But in my case, I'm based in Oakland and we provide technical assistance, support and programs, trainings for the development of worker cooperatives. And so my experience is more in finances, taxes, and governance. And there's another question in the chat. Yes, of course. If you are using an Uber for a work meeting, you have to carry out a service somewhere and you use that to be able to get there, that's a travel expense. So it's an expense of transportation to be able to arrive somewhere. And Esmeralda, I see your hand is raised. Yes, good afternoon. So my question is, so I'm an independent worker, but I'm also with a cooperative. And so to do my taxes, do I need to do it together or separate? No, you're gonna receive separate forms for as an independent contractor as 1099, and you're gonna receive a K1 from your co-op. And so you're gonna pay all your taxes from based on all the income that you received during the year. You're gonna receive a form, and so you're gonna give all that information to the person who's preparing your taxes. And so based on that, I'm gonna pay. Perfect, thank you. No, you're welcome. And I also want to add here the 1040, the payments of our income tax, and I'm gonna also add the typical deductions that we can make. Sorry, I have a question. Sorry, I know we're about to finish. Yes, go ahead. So the question is the following. So none of us as worker owners can do our personal taxes, but we're doing our business taxes. Because last year I did my personal taxes because I wanted to do them quickly without considering that the K1 form had to be processed first. So I just want to be clear on that issue. Yes, I'm not an accountant, but if your business provides a K1, so that K1 is also part of what you're liable for taxes for. So I have to wait for that K1. Yes. All the forms that you know that you'll be receiving, if you're an employee, you're going to be receiving a W-2 too. If you have not received it, to call your employer to make sure that they send that to you. But I have a question. Sorry for the interruption. Adri, go ahead. So I have a question. When does a cooperative has to deliver K1? What's the deadline for them? Because last year I had the same thing as the colleague here, because I did my income taxes at the beginning of March and I didn't receive the K1 until the end of March. So this year I've been requesting the form in February 7, and we have to submit this. So I don't know how the law applies to this. So the process, the business has the obligation to hire an accountant. So we have the obligation to hire an accountant and to do this with plenty of time to be able to provide the information that we need, that the worker owners are going to be needing, their K1. There's not a date. The deadline is that I need to submit my taxes on April 15th. So that's my own deadline as an individual owner. The business has as a deadline to pay, to send this declaration by March 15th. So after March 15th, why did it take longer? Because March 15th is when they needed to submit that information. So that has to be ready at that point because it's a full document. So that's where the process goes of doing the process for each worker owner, each one with their K1, and on the state level as well. So the business can pay on April 15th, but they have to submit their report on March 15th. So the process of distribution, those K1s to the worker owners, I'm not sure. Maybe you have to talk with the finance person and see what was gonna, or maybe the accountant delayed in delivering that information to the business. So how can we support the person who's in charge of finances so that those are done with enough time? So just keep in mind that the first days of April is still time when the accountants have that time. So the cooperatives are not obligated to submit these forms in the same timeline? No, they do. Yes, of course. So the date the accountant has to submit this tax declaration by March 15th. So that's when the document was generated, the 1065, the K1s, and from there, you have to see what the internal process is in the cooperative. If you didn't put a deadline, you have to set that. The finance side should send those K1s by April 1st, and you can generate an internal policy, but you're the owners of that business. So you need to get organized and meet. How do we, this is going out too late, so we need to have this delivered sooner. It's a worker owner. We do have somebody who's processing all that, and that person already obtained something to be able to fill those forms. So this year, it's going to be a little bit easier and a little bit faster process. Yes, and I don't want to do Muse my processes after March because it gets complicated for everyone. So if there's something I need to look for it, it's not going to be enough time for the person who's preparing my taxes. So I don't want to be a victim of that situation. I had a very bad experience last year. So that's why I'm asking that information to be able to encourage a person who's doing that we need to have this information, but they're not using the information for because there's somebody else who's processing that information. So that wait period is what is worrying me. Yeah, perfect. And yeah, so there's a conversation there among the members. How by March 15th, this person, I don't recommend having somebody who is not an accountant, whether it's an accountant, a CPA, or a bookkeeper. That's or not a bookkeeper, sorry, accountant. It's more complicated to do the K1. So if the accountant does not have experience doing it, I would look for somebody who does have experience, and I wish I would have stats or referrals, but there is not many. We could talk here in the Federation who have been working in that area to see who you've been working with, because it's very important for that person how to treat the cooperative that's an LLC. Not all accountants do it. So I see Esmeralda, we're already above time. I put in the chat that we can't go on with the questions to respect the time of everyone. If you want to be in contact with Daniela, she shared the information of Colmenar to be able to, you can communicate with Colmenar, or you can also receive technical assistance through the Federation with our cooperative clinic. And here I've shown a few events to be able to share. The first two are like how to start a cooperative. If you have friends who are starting and they still don't know the complicated nature of taxes, if they want to start a co-op, to be able to come to these workshops. And so the dates is a virtual summit where they're going to have a focus on finances in May, and the other one is if you're already a member of Federation, we're gonna have our membership meeting in spring, also in May. And with that, I'm gonna close this session and thank you, Danny, for teaching all this in such a short time. And we're gonna share this recording so that you're able to review it 15 times with your co-op. Thank you. And I see that you put a bench as well, and that's very good. I use it for information as well. So that's a good link. Thank you. And sorry, interpreters. I have to go to a special course to be able to slow down that I have culturally to speak. I hope it wasn't too terrible. And thank you, Tilde, for trying to have exit with our interpreting. It's obvious for the type of questions that we have. And thank you for supporting this webinar. Ciao.